So investment in equity securities, right? When you actually buy other companies shares and stock, right? You're investing in other companies shares. That's when you call it uh, investment in equity securities. So if you have a stake less than 20% of the outstanding shares of that company, you basically call it fair value through net income. It's also called cost method, right? Earlier it was called cost method. All right, so let's see what are the typical scenarios here. Okay, before that, 20 to 50 percentage investments, you will follow something called equity method. Okay, more than 50, more than 50 percentage of the outstanding shares that you have bought from other company, that will be, you will have to basically consolidate that company, which means that's your company, right? You're the major shareholder, so you'll have to consolidate that company, right? So these are the specific uh, stake percentages that you need to watch out for each of these methods. Now, what is fair value through net income method? Let's go deeper, right? Fair value through net income method. Fair value through net income, right? What do you? So, for example, let's say we invested in 100,000 shares of 100,000 shares, or let's say we invested 10,000 shares. We bought 10,000 shares. Okay, shares of XYZ company. Okay, and let's say one share is trading at $10. Okay, so what do? We would call it as, this is our first entry. Let's say we bought it at 1st January. Okay, 2022. Okay, what's our entry? Okay, investment in XYZ. Okay, 100,000, because 10,000 into 10, 100,000 to cash. This is the entry that you pass, right? This is the entry that you pass to cash, 100,000. All right, so this is the first entry. Now let's say at the end of the year, this company gave us, or let's say this company earned a profit of let's say 100,000, another 100,000 the company earned. All right, and they declared 50% dividend, which means they in fact uh, gave us a dividend. All right, let's say our investment in this company is 10%. Okay, our investment in this company is 10%. That's the reason we are calling it fair value through net income. So the company declared 50,000 dividends. Of that, 5,000 is for us, because we are 10% in stakeholder in the company, right? So let's say this is in June. Okay, 30th June. Okay, they gave us dividend. So what do we book it as? We would call it cash to dividend income. Okay, to dividend income. This is what we do. Okay, 5,000 dividend income. All right, so this is what we do. We might have to do a valuation at the end of the year. We'll see what is the value. If the value has increased, let's say 31st December. Okay, 2022, let's say the value has increased to $20. So basically you would book this entry, investment in XYZ. Okay, it has gone up by another 100,000 to unrealized gain. Okay, 100,000. So these are your entries. All right, so this is the first entry when you buy the investment. This is when you get a dividend. Okay, this is to adjust your fair valuation at the end of the year. Fair enough, right? So that's about fair value through net income method, right? Or cost method we call it. Now let's say you have, let's say, 30 percentage stake in a company. Okay, 30 percentage stake in a company. You have 30 percentage stake in a company. So if you have 30 percentage stake, basically you fall under the 20 to 50 bracket. So you have to use something called equity method, right? You have to use something called an equity method. Okay, under the equity method, the first, let's say you invested $200,000, or let's make it for simplicity $100,000. Okay, investment in ABC company. Put it as ABC company, 100,000. Okay, to cash. So the first entry is going to be the same, be it be equity method or be it be cost method. It's going to be the same first entry. Okay, this is on first. Okay, right. And then let's say this ABC company earned 10,000 profits. It earned 10,000 profits. So we have significant influence here, right? Why we call it significant influence? Because we have 30 percentage stake in this company. Our say is valuable in this company, so we call it significant influence. We don't have a majority of stake, but we have a role in the management, right? Therefore, when this company earns profit, basically we can go ahead and book our portion of their income, right? We can book it as our portion of their income. So what do? We pass this entry, investment in ABC. Okay, and we specifically use an account called equity in earnings. Okay, this is to show, this is an account which shows equity participations in other companies. So how much is the company earned? 50,000. Is all 50,000 for us? Of course not. It's only our share, right? We have a 30% stake, so we'll book our share of their income. Okay, 50,000, 30 percentage. How much is it? 15,000, right? We would book this entry. Okay, this is to reflect our share of their income. Let's put it as our share, 30 percentage of their income. Okay, this is to show our share of their income, right? Is the entry finished? No. What else? Let's say that company gives us a dividend. Out of the 50,000, they gave 10,000 as dividend. They retain 40,000. They are giving us, they gave all the company, they declared a dividend of 10,000. Right. So that's a dividend, right? So let's say we also got a cash. How much is based on our share? 10,000, 30 percentage is 3,000. So we got a cash of 3,000. But where do we what do we credit? We would have to credit investment in ABC. Okay, investment in ABC. Why are we debiting the investments? So basically now the company is worth less, right? So dividends reduce dividends reduce investments. Okay, dividends is going to reduce your investments. All right, so dividends are going to be reducing your investment. All right, there is one more entry which is to show the the amortization of assets exceeding the fair value, oh sorry, exceeding the book value, and probably amortization of goodwill and all, which will be slightly confusing again, but this is what we have to understand. I think I want to stop it there because I don't want to confuse you guys. um, One more time. Now if you see both the methods, investment, uh, if you want to see the equity method and cost method. So let's get into fair value through net income. you will show the first entry is going to be the same, right? Both are cash to investment. But here, when they get the investment, sorry, dividend is an income for them. Okay, for us, okay, for us, if you're using equity method, dividends are not to be an income. It's going to be a reduction of capital. Okay, it reduces the investment, right? And we don't pass this entry. We do not pass this entry. This entry we don't pass it for fair value through net income. This entry here we are booking this as you know, our share of their income. Okay, now this entry here, it is an income. Dividend is an income under cost method. Dividend is a reduction of capital under equity method. First entry is going to be the same. You see both this entry, this one investment to cash, this is also investment cash. All these entries are going to be the same, right?